Futures are unched on the S&P ahead of the Fed meeting. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, a policy pivot. The Federal Reserve prepares to deliver its long-awaited rate cut today to support a shaky labor market.
Deals and diplomacy. President Trump's UK visit kicks off with Microsoft, OpenAI, and other American companies announcing plans to spend billions on tech infrastructure.
And documents show Treasury Secretary Scott Bessent made the same kind of contradictory mortgage pledges that President Trump has been using to try and fire Fed Governor Lisa Cook.
Matt, a little bit of breaking news just crossing on Eli Lilly. So let me take you to the share price reaction, because we were down about 0.7% in the pre-market. This is actually better than where we just were. We were down more than 1%. It's a new study released finding that Eli Lilly's oral GLP-1 pill helped participants lose an average of 9.2% of their body weight. Shares are still off, though, because that is below an 11% weight loss from an earlier study. Matt, it's also worse than their shot, also seemingly worse than Novo Nordisk pill as well.
Yeah, and we've got commentary from the C-suite coming up on the program. China's internet regulator has told the country's biggest technology companies to stop buying all of Nvidia's artificial intelligence chips and terminate their existing orders. This, according to an FT report, but it adds to a number of instances, Dani, this year where the Chinese Communist Party has tried to get domestic companies to quit buying Nvidia chips.
And it may be signals that they're ready to do that chips in Asia and China are advanced enough to replace some of that. But Matt, we need to start with the top story, and it is the Fed's expected rate cut today. Bank of America Chair and CEO Brian Moynihan spoke to Bloomberg in the last hour. Here is what he's expecting to hear this afternoon.
The tension the Fed has to deal with, and you've been picking at it all day, is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. And so whether they do 25 basis points today or 50, people have to keep in mind the growth rate in the economy was brought down, and now it's starting to go back up. So next year is predicted to be better than this year, and the year after is better than that.
Michael McKee, Bloomberg's international economics and policy correspondent, joins us now from Washington. So, Mike, aside from, the relationship fireworks that we can only speculate about in this meeting with Stephen Myron and Lisa Cook, both on the board, what do you expect from Jerome Powell in terms of policy?
Well, Matt, those relationship fireworks are actually going to be one of the more fun things to watch. But let me start with a public service announcement you're going to have to watch. The Fed decides on Bloomberg TV at 1:30 Wall Street time this afternoon, because this is going to be the most complicated, interesting meeting we have had in years. Markets are expecting a 25 basis point cut, but they also want to know what's next. Do we see a cut in October? Do we see a cut in December? What about 2026? What's the path forward? That's the key question in terms of monetary policy. Inflation or employment? What are they focused on? That was the Brian Moynihan question you just heard. And then who and how many dissent. And that's going to be really interesting to look at, even if it doesn't mean a whole lot for policy right now, because the Fed is extremely divided here. There is a possibility we get 3 dissents in favor of 50 basis points. It would be Stephen Myron, who just joined the board, of course, from the White House, Mickey Bowman, and Chris Waller. They might dissent for 50 basis points. And at the same time, we might have 2 dissents in terms of no cuts at all. Jeff Schmidt and Alberto Musalem, who've made it plain they don't think there should be cuts at this point. Now, the question about all of that is, at least on the 50 basis point cut team, how much of that is because they really think the economy needs 50 basis points, or how much of that is because they're playing to an audience of one who happens to be in the United Kingdom right now, because he is considering all 3 of them for the possible job of replacing Jay Powell as chair of the Fed. So how much weight should we put on these dissents? It's going to be a tough meeting to decipher, and it is not going to be a lot of fun for Jay Powell at his press conference this afternoon.
Hey, Mike, quickly, because we're also going to get the dots this meeting. Stephen Myron wasn't a governor as recently as Monday. Will his dots, will his estimates, will they factor in this time?
It's going to depend on him and whether he submitted anything. The Fed would put in his dots and his summary of economic projections forecasts for the economy if he brings them. Last time we had a situation like this, Lael Brainerd came to the Fed shortly before a meeting and did not submit any estimates. So we don't know exactly whether we're going to get a Myron view or not.
All right, Mike, great to get your take on this. And obviously, we're going to be talking to you all day, and we will tune in to watch the Fed decides this afternoon. Michael McKee there in Washington, where he'll be in lockup, I guess, until that decision is released. In tech, China's internet watchdog has instructed companies including Alibaba and ByteDance to terminate orders for Nvidia chips crucial for AI development. This, according to the Financial Times. But as I said earlier, we've seen a number of cases so far this year where through one regulatory arm or another, the Chinese Communist Party has urged domestic companies to stop buying Nvidia chips. Bloomberg technology co-host Caroline Hyde joins us now on set to talk about this. And is it finally going to happen? Are they finally going to quit?
It feels as though the sentiment is of confidence coming from China, that they think they have the local domestic supply to say, no, we don't need your H20s, and now we don't need your RTX 6000Ds either. These were specifically based on Blackwell architecture, designed for the Chinese market, particularly in manufacturing. This was about digital AI twins and the like. This was another type of chip other than the H20. Now, we know the H20 had been limited by the US government. Now they're allowed back in with a 15% cut for the US government. But already Bloomberg had been reporting out that companies such as Alibaba and the big Chinese domestic players had been lent upon by the Chinese government not to buy them. Now this is another type of chip that they're saying, please don't buy these either. In fact, really enforcing that they shouldn't. And any of the testing needs to stop. Any of your orders needs to be unwound. And in fact, Jensen Huang is over in the UK right now. He's been in front of the press. He's been talking. In fact, Bloomberg has his own reaction saying, of course, he's disappointed by the ongoing issues between China and the US. He says we can only be in service of a market if the country wants us to be there. And so clearly this is development that he's going to be sitting down at the banquet with President Trump tonight in the United Kingdom and trying to bend his ear around.
It's a great point because the timing of this is so interesting because also not only are these negotiations ongoing, or is this back and forth ongoing, but TikTok too? And it seems like on that front there has been progress.
Look, the relationship between China and the US in the future really hinges on technology, whether it's yours or mine use of social media, or whether it's the ability to generate billions and billions with AI GPUs. And I think TikTok looks as though the framework is there. We're sort of piecing together what it really looks like. Silver Lake's involved. Andreessen and Horowitz is involved. Oracle, we understand, is involved, but probably taking a smaller chunk in terms of actually owning equity. But this is an infrastructure provider. This is about giving it cloud offering. This is about, of course, managing Project Texas, where it protects data from the US and other users from access by the Chinese government. But all of this is about really the ins and outs. Will we get a whole new app? That's what we seem to be understanding, according to people familiar. But you and I, if we're on TikTok, I know Matt isn't, but we'll have to move onto a totally different app, but the license is there for the algorithm. And I think that was a key question. Will we have access to the secret source? And many felt that China was going to say, no, you can't, but maybe they're going to license that. So that's a big compromise on the side of China. But what's the price point? We knew it was maybe $30 to $40 billion was talked about, but valuations have gone nothing but up and to the right. So maybe it's a little bit more than that. And really, how much and what Chinese players still do they own? Maybe less than 20% is what's being talked about in the market. But as the White House has time and time and said again, this is pure speculation until it's announced on Friday between that talk.
All right, well, we're going to learn all the details on your program later today and throughout the week.
Can I say lovely tie?
Thank you. I've got, actually, can you zoom in here? I've got from Van Eck here. It's a Jerome Powell tie.
And
he's holding the 60-40 portfolio there. In
the
honor,
suggestion that he holds 60-40 is in the fate of Jerome Powell's hands.
I don't know why they made it like that, but it's just a fun
diversification. That's what we got to remember.
Fed Day tie. We look forward to Bloomberg Tech. I know you've shortened the name. I just like to say the whole thing for nostalgic reasons. Caroline Hyde co-hosts that with our buddy Ed Ludlow. Now, U.S. companies pledging to spend tens of billions of dollars on technology infrastructure in the U.K. as President Trump's two-day visit to the island nation kicks off.
They want to see if they can refine the trade deal a little bit. We made a deal, and it's a great deal. And I'm into helping them. Our country is doing very well. We've never done this well. We're making We're having trillions of dollars coming because of the tariffs. They'd like to see if they could get a little bit better deal, so we'll talk to them.
Joining us now from Windsor Castle is Bloomberg Surveillance co-host Anne-Marie Hordern. It's like you belong there, Anne-Marie. What a fantastic 11th century palace. What do we know about the deals, really, which have got to be the biggest headlines for us?
Absolutely. We are talking about tens of billions of dollars, just $30 billion alone when it comes to Microsoft and their investment in the United Kingdom to building out AI data centers. You see all these companies lining up, like Sam Altman with OpenAI. And as Caroline Hyde just said, Nvidia's Jensen Huang also going to be part of this trip. And what the United Kingdom is looking forward to is trying to become an AI hub, an AI data center hub when it comes to building out infrastructure in Northern England. And this is really critical, especially at a time right now for this prime minister, when we thought that potentially refining, as the president put it, of the trade deal would be on the table. The UK wanted to put forward bringing the steel tariff from 25% to 0, as well as maybe an exemption. I know something may be important to you, Matt, Scottish whiskey, but that seems to be that the UK is just capitulating and they're not even going to discuss it. So really for them, the big win is going to be AI. After all, of course, all the theater that's taking place today inside the castle walls, the evening will start to feel a little bit more business oriented because the president's going to be flanked by all these executives for the state banquet. And then tomorrow he'll be sitting down in earnest with the prime minister.
Anne-Marie, we're looking forward to catching up with you throughout the hour as those events unfold. That's Bloomberg's Anne-Marie Hordern reporting from beautiful Windsor Castle.
By the way, when I drink,
yes,
it's bourbon, because I am a redneck at heart, right? I'm from the great state of Ohio.
Well, now bourbon costs you less, too, so that makes sense, versus a whiskey that you have to import from abroad.
Absolutely. I'm saving money and true to my roots here. We want to look at futures as we approach the Fed decision. We hit again an all-time closing high yesterday, and you can see futures on the S&P and the NASDAQ are unchanged. It looks like the small caps may benefit even more from this, as the large caps have already had a significant rally since the first cut. If you believe that this is the same cycle, right?
Right. I guess that makes a difference. Is this a new rate cutting cycle that we're embarking on? But at a 1/3% gain, if small caps can gain again this week, they've been rallying since that poor July jobs data. But Matt, it's really because treasuries have come down so much. We're talking about 4% on the 10-year yield right now. When it was only a couple weeks ago, we were saying that long-end bonds yields were remaining stubbornly high. It's completely different going into this Fed decision.
Yeah, it's fascinating. It's also brought mortgage rates down. We're going to talk about that throughout the program. I just want to point out quickly that Bloomberg Intelligence looked at all cutting cycles in the past and found that across all of them, you get an average 15% gain on the S&P. Now, we've already had a 17.6% gain since the first cut. So if this is the same cycle, maybe that's run its course. But if it's a new one,
guns go
we're
off.
Off to the races.
Off to the races. Okay, coming up on the show, Treasury Secretary Scott Bessent once claimed to occupy 2 primary residences at the same time. That might sound familiar to you. We're going to have that Bloomberg scoop coming up next on Bloomberg Open Interest.
Let's get now to high interest. It's a look at what's making headlines around the world. Lyft is partnering with Waymo for the first time to offer robo-taxi service in Nashville starting next year. The partnership will help it better compete with Uber, which has robo-taxi services, at least in Austin. Lyft has been playing catch-up with Uber and making driverless vehicles available to its customers. BlackRock's Rick Rieder is revamping his fixed income empire around new investment strategies and artificial intelligence. The move comes as the unit's leveraged finance business moves under an executive team from the firm's newly acquired HPS Investment Partners, and the move underscores the growing clout of the private financing team. It's a key business for BlackRock as it expands in private and alternative credit and competes with Blackstone and Apollo. Treasury Secretary Scott Bessent once agreed to occupy 2 different homes as his principal residence at the same time. That's according to documents seen by Bloomberg News. It's the same kind of contradictory pledge that President Trump has been using to try and oust Fed Governor Lisa Cook. Dani?
Let's get more on that story and bring in Bloomberg Washington correspondent Tyler Kendall, who joins us now. Tyler, what do we know at this point?
Yeah, hey, Dani. Well, Matt really outlined there this breaking news this morning from Bloomberg News, which reviewed these mortgage documents, finding that the Treasury Secretary had entered into conflicting agreements obligating him to occupy two separate houses, one in Massachusetts, the other in New York, as his primary residence. This is from 2007. Both mortgages were provided on the same day by the same lender, Bank of America. One property is in Bedford Hills, New York, the other in Provincetown, Massachusetts, part of a broader $21 million financing package. But evidence shows that the bank wasn't really relying on these pledges, never actually expected the Treasury Secretary to occupy them both as his primary residences. And we did get a statement from one of Bessent's lawyers. In fact, he was the one that had power of attorney and signed these documents for Bessent, saying in part that Bank of America was fully aware the Massachusetts property was not a principal residence, and adding that, quote, absolutely nothing improper happened here when it comes to Mr. Bessent's loan applications. And mortgage experts agree, telling us for this story there is no sign of wrongdoing on Scott Bessent's part, but rather this could demonstrate how discrepancies when it comes to mortgage applications don't necessarily amount to fraud. It's showing some pretty striking similarities here, though not identical to the case against Fed Governor Lisa Cook, who also is being accused of listing primary residence on two of her mortgage applications, though a document reviewed by Bloomberg News over the weekend shows that she did list one of them as a vacation home. So perhaps showing us a similarity here that the bank or the lender was not thinking that she was going to use that as a primary residence. And Cook's lawyers have argued that she didn't have any intent to mislead anybody when it comes to her applications.
Right. It's important to point out that it looks like in both cases, the lender was aware that at least one of these homes for each person was not a primary residence. But this seems like it's happening all over the place, right? ProPublica has reported that many members of the Trump administration, Sean Duffy, Lee Zeldin, and others, aside from Bessent, have at one point or another claimed more than one residence as a primary residence in mortgage documents. Meanwhile, the president and his allies have accused a number of people, including Letitia James and Lisa Cook and others, of the same thing. So it's like a back and forth, but it seems like everyone's doing it.
Right, and that piece from ProPublica that we're showing also highlighting the allegations against the Labor Secretary, Lori Chavez DeRemer, who we did hear a statement from her lawyer saying that she did follow the law there. But you're exactly right, Matt. This continues to come up, and particularly from the Trump administration against those political adversaries like Letitia James and California Senator Adam Schiff. But I would point to that is why when we are hearing from the courts, particularly around Fed Governor Lisa Cook's case, this idea of a due process is going to keep coming up. We had heard from the appeals court earlier this week that allowed Cook to retain her seat. They didn't rule on this issue of whether or not President Trump had sufficient cause to fire her, but they did rule saying that he very likely violated her due process rights to defend against these mortgage fraud allegations. And I think that's going to be a really important thread for us to continue to follow here as more of these instances come to light.
All right, Tyler, thanks very much for the reporting. We're going to have more on this story in the next hour, by the way, with Pulitzer Prize-winning Bloomberg News reporter Zach Miter. He'll join us to talk about the details. Coming up, Ron Temple of Lazard joins us, and he'll talk about the broadening out of earnings that we've seen and risks from the Fed cutting with stocks at all-time highs. I've heard at least one analyst say this is a Fed cut because they can, not because they have to. We'll ask Ron about that. This is Bloomberg Open Interest.
If the Fed is cutting, but inflation has not been, sufficiently managed, I think that's the risk. Short rates have actually done very little to stymie large cap company performance. Absent yield curve control, the long end, I think, is really potentially more dramatic for the S&P.
That was Bank of America strategist Savita Subramanian. Now let's get the view from Lazard's chief market strategist, Ron Temple. Ron, thanks for joining this morning.
Pleasure
Great to see you.
Thanks.
It's a market that is priced and positioned for a dovish cut. Is today going to be a sell the news Fed decision?
Honestly, there are so many things we're going to have to parse through today. It's going to be a really interesting day for those of us who are kind of Fed geeks. But basically, I'm going to look for the size of the rate cut. I'm really interested in the possibility of a three-way vote split in terms of some voters saying no cuts, some saying 25, some saying 50. Want to see where the dot plot lands. Want to see what the long-run neutral rate for the Fed funds is pegged at in the summary of economic projections. And then, pity Chair Jay Powell. Somehow in the press conference, he's got to navigate conveying the views of three different camps of potential voters. So I think there's a lot to see there to decide then how to react. I mean, I guess the thing I'm most worried about are any signs of a politicization or a gradual decrease of Fed independence. Because to me, in the longer run, that's much more important than whether we get 25 or 50 today. What the market should be focused on is this Fed still singularly focused on achieving its dual mandate and focused on the data, not any incoming political noise from the left or the right?
Right. Although the bond market hasn't shown that any investor really cares about that because it's been so politicized already. We'll continue to talk about this. Ron Temple is going to stay with us. We have the opening bell up next, and you can see that futures are still unchanged here at 6668 on the S&P. NASDAQ futures unchanged at 24,520. We are moments away from the start of trading on this Fed day. This is Bloomberg Open Interest. I'm Matt Miller, watching very little change in terms of futures right now. This isn't unusual, right? Traders often sit on their hands and wait for the actual decision to come out, turn off the algorithms so that they can interpret it themselves. AI is getting better, so maybe they do that less and less. You hear the opening bell ringing at the New York Stock Exchange. Look at here, Eric H. Baker, founder and CEO of StubHub, ringing the opening bell on their IPO day. We'll be talking about that later in the program. And then, Dani, you were right. He is wearing pink.
Nailed
it's
it.
like an orange pink.
Like highlighter pink.
The blazer. Dan Ives there ringing the bell for 8Co Holdings. That's a company that he advises there. He's got a lot going on. This tech analyst has got an ETF.
Clothing
he's got
line?
a clothing line that he's showcasing there, 8Co, and of course his day job at Wedbush.
Yeah, his day job and also TV appearances. He joins us a lot, and we're looking forward to the next Dan Ives appearance as well. Something that Dan Ives himself might be commenting on this morning when he's done opening the ringing bell. Look at this move in Lyft. Up 12% this morning. It's partnering with Waymo to offer robo-taxi services in Nashville starting next year. And as part of this partnership, Lyft will also construct a fleet management facility with charging capabilities. Bad news for Uber, who's also been trying to roll out robo-taxis as well. Those shares down 1%, Matt.
All right, so that's the I guess the ride-hailing scene. Let's look at the big kahuna. China's internet regulator has told the country's biggest technology companies to stop buying all of Nvidia's artificial intelligence chips. That means they won't be able to buy the Hopper or the Blackwell or the H2O or whatever they've got, and terminate existing orders as well. This according to the Financial Times. Investors aren't taking it too badly right now. The shares are off, but only 1 1/3%. It's a big move, because the company is so heavily weighted. So you may see it weighing on the indexes, but it doesn't look like such a huge drop compared to how far they have come. We are back right now with Lazard, Chief Market Strategist Ron Temple. And let's talk about that, how far they've come. Ron, what do you think about the fact that, Torsten Slok put out a slide showing how overexposed investors are to AI and these mega cap tech companies? Is that going to be a problem?
Longer term, it's increasingly worrisome. But if you look at where the earnings growth has been in the market in the second quarter, S&P earnings up about 11%. If you took out the broadly defined tech sector out of that number, earnings growth was only about 3.25%. And by the way, if you took financial services out, you're basically at a zero. So if you think about where you've been able to get earnings growth, it's been in this part of the market. One of my concerns is longer term, how sustainable is that growth? And a couple of firms have been highlighting this lately. You know, you have this massive CapEx and the hyperscalers trying to ramp up their investments in AI. But basically, that's all recognized as revenue today, but the expensing is amortized over multiple years. So the more we spend, the better off we are. But if you never get a return on that investment, it's going to be a problem. Or if the return on the investment is 7 years from now, it's a problem. So I am worried about the concentration in the market. But I don't think that necessarily means you move out of cap weighted into equal weighted. I think you just really want to be careful on your security selection.
It's so interesting you say that because Bank of America's investor survey earlier this week talked about this idea that more investors are rewarding companies for capital expenditures versus taking care of their balance sheets.
Right.
Does that continue on, or does that change at some point? Do we start to get worried about how much spending these giants are doing?
Well, it's interesting. If you go back a few years ago, part of the whole story of why tech was doing so well, it was capital light, high margins. And now the exciting part of tech is incredibly capital intensive. And so, again, there's a bit of a worry there that if we think back to 99, 2000, we loved that people were pumping money into CapEx and, you know, fiber optic cables and servers. At some point, we realized that maybe that wasn't the right approach.
I think about it a lot, dude. Cisco. I mean, they were paying so much, everyone was, to lay cable, and it turned out not to pay off until like 7 years later.
Yeah, I mean, the hard part of all of this, though, is I don't think any of us would disagree that AI is going to be revolutionary, and you want to spend the money because you'll get returns. The question is, how long can it last? And I wish I were smart enough to make that call, but I do think it's probably wise to pull a little money off the table.
Well, okay, there's the argument that maybe it's like the .com and it's like laying cable, but then there's the other argument that this is railroads, that this is infrastructure, not only that the U.S. needs, but every country needs, and if you don't have it, you're going to be left behind. How do you decide between which of the two poles we're standing at?
I think that's where you basically go through stock by stock and you figure out which one is most likely to have that pole position to be in the lead in this area, which one is being most careful about their capital allocation while dumping the right amount of money into it. It's a hard question to answer. Unfortunately, I can't give you that answer right now because I don't know it.
What sectors do you like outside of tech? You know, if you look at the S&P 493, and obviously there are a lot of tech companies in that, but if you look at the rest of the S&P, where do you see the most opportunity?
Well, honestly, where I see the most opportunity might be in non-U.S. equities at this point beyond tech. I mean, tech U.S. looks great. I do think in the near term you could have some beneficiaries from rate cuts. You've already mentioned this earlier. I believe small caps actually are a beneficiary of rate cuts, so there could be a positive opportunity there. But when you really start looking outside of that kind of tech longer-term story, and then more recently financial services, more of a cyclical deregulation credit cycle story, being better than expected on the credit cycle. You know, I think right now a lot of the parts of the market, the old economy parts of the market, are most negatively affected by tariffs. They're most negatively affected by immigration policy changes. And so when I think about this, I think the best opportunities for investors right now may well be outside the U.S., and I would highlight emerging markets in Japan at the top of that list. Partly because those equities, I think, have upside, but also because I think the dollar has meaningful downside. And from a total return perspective, investing unhedged outside the U.S. could be a good place to put that next dollar of capital.
I know you have been talking about this, Dani, but I just want to point out quickly on the small caps.
Yeah.
I keep falling back on this BI piece that Michael Casper and Nathaniel Wellenhofer put out this morning, showing that small caps are the biggest beneficiary of rate cuts. If you go back across all the cutting cycles, large caps have averaged a 15% gain, small caps have averaged a 17% gain. And so obviously this time could be different, but...
Well, I guess the key for that, though, and Ron, I'm sure you see this too, that small caps do well if it's not a recession. Yeah. If you're cutting into a recession, it's completely different for these companies that, again, don't have the buffer of all of the AI spending. So if these cuts are being done because it's a labor market, or we get hints that it's going to be something like a 50 basis point cut, that those might be to come, can small caps continue their rally?
And Casper and team pointed out that in rate cut cycles where we weren't going into a recession, small caps have rallied 19.6%.
That's strong.
So even stronger.
I think this is more of that scenario. By the way, I'm not worried about recession risk. If anything, to me, the whole debate for the Fed is, you know, what if unemployment really doesn't go up very much? And again, that's a whole other topic we could spend a lot of time on. I think recession risk is quite low. And the reason small caps do so well, by the way, is they have twice the debt to capitalization of large cap. And about 40% of small cap debt is floating rate. Only about 10% of large cap debt is floating rate. So you get an immediate benefit that's magnified. And if recession risk is quite low, this is positive for those small cap companies. The risk is, though, I think the economic outlook is not one that's getting better necessarily in the next 2 years. My view, quite strongly held, is that because of the decrease in immigration flows to the United States, potential or sustainable real GDP growth is downshifting, not shifting higher. So in the past, economists would say we can grow 1.7 to 2% per annum. I think that might be more 1 to 1.5%. And if you look at one last data point from the Bureau of Labor Statistics, year to date, the labor force of foreign-born workers in the United States has decreased by 1.1 million people. In the prior 2 years, we had 3 million immigrant arrivals. That's fewer customers, fewer workers, less output. And so it's a really tough thing to navigate right now, which I think is why there's so many questions around what the Fed should and will do.
Well, I wonder just quickly why everybody is writing off the chance that we could be heading into a recession. Yesterday, we were talking with Tiffany Wilding at PIMCO, and she said big companies aren't passing on tariff costs because they're just firing workers instead to support margins. And small companies are just going out of business, right? If you look at small private companies, bankruptcies are rising to record highs. Joe Brusuelas, an economist that I've been talking to for 20 years, pointed out today that heavy truck sales are falling, and that does often indicate a recession.
No, there are definitely signs of weakness in the economy, but layoffs have basically remained very low. So the data is not showing layoffs. What we are seeing weakness is hiring rates. Companies don't want to hire anyone. We see this with recent college grads in particular. So there are signs of weakness. But I guess when I look at it, the consumer balance sheet is in a great place. I mean, if you look over the last 5 years, consumer net worth is up about $67 trillion. It's an enormous number. Corporates have very strong balance sheets for the vast majority of them. This is an economy that's in a pretty good place. And so the risk of recession, I don't see any of those typical early signals, or not, at least not enough of them, to be losing sleep at night. And I think the markets agree. If you look at credit markets, credit spreads are very tight. Markets are quite comfortable.
Mad tight.
Tightest, I think, since the 1980s, late 1980s, somewhere around there.
But that's a demand story, right?
Yeah. Oh, there's so much money flowing into that. Ron, this has been so fantastic. Please come join us again soon. That's Lazard Chief Market Strategist Ron Temple. All right, a quick check on where markets stand right now. If you look at your move screen, this is an equity index that is little changed. Maybe that changes after 2 p.m. when we get the Fed decision. Tech on the top and tech on the bottom. Apple leads us higher in terms of points. On the bottom, maybe it's more interesting to look at how poorly Nvidia is doing today, down 2.3%, dragging down the index with it on that FT story that China is banning chips. Elsewhere for the sector mover, it looks like the inverse of where we were at this point yesterday, and that is you look at tech and consumer discretionary are down. Infotech down because of Nvidia. We also had General Mills earnings that maybe flagged some weakness, people looking at buying smaller sizes and making food at home. Consumer staples, though, up 1%, Matt.
All right, when we come back, we're talking about Oracle stock surge. Analysts are concerned about a potential bubble. We'll ask Jefferies analyst Brent Thill what he thinks. This is Bloomberg Open Interest.
Let's look at some of the top calls this morning, the analyst action that we are focusing on. First up, Berenberg downgrading Eli Lilly and Merck. For Lilly, he says that the obesity upgrade market cycle has plateaued. And on Merck, the analysts cite a looming patent expiration for a key drug in 2028. Zillow, that gets upgraded to a buy at Bernstein thanks to improving revenue and potential tailwinds for lower rates. Finally, Workday gets upgraded at Piper Sandler following its Investor Day event. The analysts say the company is becoming more relevant in the AI era. Those shares surging this morning after Elliott Management also says that Workday has made substantial progress in recent years and takes a stake. Let's stay with tech. And Oracle is among the consortium of TikTok buyers that will keep its running in the U.S. Shares of the stock have been climbing so quickly on earnings and AI deals that some analysts have started to worry that it is maybe in a bubble with a price to earnings ratio in the 40s. Let's discuss this with Jefferies analyst Brent Thill. He has a buy rating on Oracle on the stock. Brent, great to see you this morning. And look, this is a company that was once sort of viewed as a sleepy growth tech player. How much has your view changed of Oracle as it's become serious on both the world stage politically and on AI?
Yeah, I mean, we think Oracle's in a really good spot. They're inflecting on the OCI, their cloud business. We continue to believe that Oracle remains the biggest market share gainer in these cloud wars. If you think about, it's really been the Amazon, Microsoft, Google show, and Oracle was sitting at about 3-4% market share. And now that market share is effectively, we believe, will increase the most rapid relative to all the other hyperscalers. So yes, is this a overweight contract with OpenAI, and given the breakup that Microsoft and OpenAI are somewhat going through, and are they a beneficiary? Absolutely. How long will this last? I think is an open question, but we still see a pathway for Oracle to get to $20 of earnings power. You put a 20 multiple, and that's $400 in the stock. Some are saying they can get to $30 of earnings power. Again, put a 20 multiple on it, and you're much higher. So in any situation, I think Oracle has really proven that the momentum's on their side. We're at the beginning of this AI build out, and I don't think there's anything that you would call in a bubble right now. We think, again, this is going to take several years to play out, and we continue to think that Oracle remains in a really good spot in terms of the biggest market share gains relative to their peers. It is not a zero-sum game. Microsoft, Amazon, and Google are also going to win. So we wouldn't say that this is just Oracle winning. Oracle's just, by definition, has the lowest market share. So they have the fastest market share gains and the fastest growth across the industry right now. And that inflection is going to drive accelerating growth into next year. And investors love accelerating growth.
First, I would point out Oracle's only trading at 44 times next year's estimates. And like, I keep coming back to this, but Costco trades at 53 times next year's estimates. Brent, what about getting hold of the GPUs? How much of this success is about Oracle managing to get hold of a big share of GPUs? You say it's not a zero-sum game, but there's only so many to go around, and Jensen Huang has to say to Microsoft, Amazon, Google, Oracle, and others, like, you get this many, you get this many, you get this many, and now we're out.
Matt, if I told you had $300 billion of capacity to build, and you're Jensen, are you going to give me those chips? The answer is yes. They have the biggest contract of anyone. I mean, no one's seen a $300 billion deal. If the Wall Street Journal's article's reporting is correct, Oracle says it might be smaller and it might be over a longer period. But whatever the number is, when Oracle added $317 billion of incremental backlog, Nvidia is going to get them the chips. And remember, Larry and again, Musk and that whole ecosystem of tech leaders are very close. So I don't think there's going to be an issue in terms of them getting what they need to get. Is there capacity constraint across the entire industry? 100%. Is everyone getting what they want? Probably not. But given, I think there are going to be favorites here. And when you bring that level of backlog and that level of build out, and again, we don't know, they didn't say who the customer was, but assume it's OpenAI, who is considered to be the AI pioneer.
Well, Brent, just on that, if I can jump in, because if a chunk,
of course they're going to get them.
Yeah,
the
well,
chips.
if a chunk of their business though is coming from a reported deal with OpenAI, is Oracle essentially a one-way bet right now on OpenAI's ability to continue to raise hundreds of billions of dollars for their build-out? And is that not a concern that it's so concentrated?
Yeah, it's 100%. It's a huge risk. But I think when you take and you look at what OpenAI's position is as the leader right now, your risk factor is low. If this is the 7th or 8th, on the track and they were 5 laps behind, but OpenAI is in the pole position, they're crushing it. I mean, they're so far ahead. So when you think about that, yeah, is there customer concentration risk? Yes. But look at the rest of the customer base at Oracle now. TikTok, the resolution there, that's good for them. You look at foreign governments that are betting big on their cloud. If you look at the U.S. and many of these corporations that are betting big, if you look at even some of the other what Musk's organization across the board, right? There are multiple organizations that Elon's in. He's obviously very good friends with Larry. You see them making a commitment on their properties. So I think that, yes, this is a concentrated risk on one contract, but there's also diversification in high quality companies that are also going after this AI race that helps insulate this. Remember, 2 years ago, everyone freaked out, like TikTok's going away, like it isn't going to exist, all of our kids are going to cry. And then all of a sudden, like, I mean, Oracle has infrastructure, so everyone says, oh, the infrastructure is going to turn off and Oracle's dead. I mean, 2 years ago, that was the wrong bet. It's the wrong bet to believe, in our opinion, that they aren't going to get this done, and that there aren't going to be others that are going to come to them. Because what you're seeing is no one in the AI race thought we would go all over. Everyone thought we'd just go to Amazon or Microsoft. No one has enough capacity, so everyone's spreading their bets across all these hyperscalers. And you can count on one hand the number of infrastructure companies that are going to power the AI revolution. It's Microsoft, Amazon, Google, Oracle, and there's a few others. Meta in the consumer world. CoreWeave is enabling this. There's very few companies that can do the scale of what's required. And this isn't just a tech movement. This is healthcare, aviation, financial services, insurance. Every CEO and every board is freaking out right now. No one freaked out about cloud. No one freaked out about Bitcoin. Every board globally is worried about AI.
Brent, great to get your take on this. I hope we can get you back. Jefferies analyst Brent Thill, he rates Oracle a buy. And if you look at the Bloomberg absolute return rating, his recommendations have garnered you the best return over the last year. Early results are in for Eli Lilly's obesity pill. We take a look at the drug's future next. This is Open Interest.
Eli Lilly's obesity pill showing some promising results. Patients on the company's experimental drug lost more weight and experienced greater improvements in blood sugar levels than those on a rival drug from Novo Nordisk in the first head-to-head trial of the two medicines. Here with more is Bloomberg Health reporter Madison Muller. Madison, we also had another study earlier this morning that maybe suggested it wasn't as good as Novo. Where exactly do we stand on the studies at this point?
Yeah, I think there's been a lot of confusion about this drug. I mean, there was so much excitement and hype. We've been talking on the show for a while about how pill versions of popular weight loss shots are going to be the next big thing in this obesity market that has really captivated everyone for the past couple of years. But in some of the studies of patients with obesity, the drug hasn't performed as well as investors were hoping. On the other hand, though, in studies of patients with diabetes, because Lilly is testing it for both patient populations, the drug has, performed a little bit better than investors were expecting. So it's an interesting scenario right now. I think overall the weight loss is a little bit less than investors were hoping that it would be. It's around 11%. They were hoping for efficacy in line with the shots, so like 15%. And so it's been a little bit of a disappointment, but doctors say they're still planning to prescribe this drug really widely if it does get approved, because a pill would be a huge new part of this market and give patients another option for treatment.
Right, and it's also important to mention that, which Dani laid out, it's not only about weight loss, right? For a lot of people, it's about lowering blood sugar levels as well. Madison relentlessly covers the pharmaceutical companies for us here at Bloomberg. Madison Muller there. You will hear an interview, by the way, some of it with Eli Lilly Chief Scientific Officer Dan Skavronsky coming up in the noon hour, and then again on the close. Katie and Romaine did that. Coming up in the next hour, Robinhood's Stephanie Gill joins us on Fed Day. We are 30 minutes into this trading day on Fed Day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger with Equities losing steam after hitting all-time highs, awaiting the Fed decision at 2 p.m. Eastern.
Coming up, policy pivot. The Federal Reserve prepares to deliver its long-awaited rate cut to support a shaky labor market.
And documents show Treasury Secretary Scott Bessent made the same kind of contradictory mortgage pledges that President Trump has been using to try to fire Fed Governor Lisa Cook.
Diplomacy and deals. President Trump's UK visit kicks off with Microsoft, OpenAI, and other American companies announcing plans to spend billions on technology infrastructure. And joining us now from Windsor is Anne-Marie Hordern. She is Bloomberg's chief political correspondent, also the co-host of Surveillance. What do we know about the deals, Anne-Marie? To me, these are the most important headlines, although obviously it's exciting to have a carriage ride and look at an art collection.
Right, that's all the pomp and circumstance and the theater that goes on with a state visit. I think something the president really relishes in. Before he arrived speaking at the White House, he talked about how it was unprecedented that he got this second state visit invitation from King Charles via the Prime Minister Keir Starmer some 7 months ago. And he talked about how last time it was at Buckingham Palace, and he said this time it's at Windsor Castle, which he called the, quote, ultimate setting. So that's all very exciting, and the British really do perform well to that task. But then when you get more to the substance of what is going on between these two countries after their trade agreement, which the UK seems at this moment really to not bring up some of the issues they have with that when it comes to steel tariffs or exemptions when it comes to Scottish whiskey, the real crux of these agreements, as you mentioned, is the tech sector and the United Kingdom trying to be an AI hub when it comes to data centers, when it comes to quantum computing. So you have the president flanked by the biggest tech executives, Satya Nadella, Jensen Huang, Sam Altman, Apple's Tim Cook notably is reportedly going to be on this trip and at the banquet this evening. That is really interesting given the fact that he was not with the president when he went to the Middle East, and the president reminded us a lot of the times on that trip that he wasn't there. So they're talking about tens of billions of dollars when it comes to these investments. Just Microsoft alone is $30 billion. And on their blog post, they talked about how this is the biggest investment in terms of AI outside of the United States. Now, one thing I would look out for is potentially any discussion, given the fact that the U.S. is dumping all this capital into the United Kingdom. Will then the United States and the president feel the need and have maybe the leverage to talk about the digital services tax, which he is definitely getting that push from more than 20 House Republicans asking him to bring this up on his visit. So today's a lot of pomp and circumstance. This evening's the banquet, and then tomorrow he'll be sitting down with the Prime Minister.
Anne-Marie, looking forward to your coverage throughout the day. Bloomberg's Anne-Marie Hordern reporting live from Windsor Castle. Joining us now on these markets is Robinhood Chief Investment Officer Stephanie Guild. Stephanie, great to see you this morning.
Likewise.
So you have all the tech giants out there in the UK planning to spend more after already plowing hundreds of billions of dollars, at least into the US. It is a market that has continued to rally thanks to the tech players. To get the next leg of a rally, how important is it today to hear from a Jerome Powell that doesn't just cut, but signals more cuts to come?
I think it's pretty important because I do think the market has secretly been discounting in more cuts, right? Like, you know, on the table has always been 2 cuts through the end of the year. So the economic projections are going to be really important. And I think the cut is definitely going to happen, but how he speaks, I was thinking about this and I'm like, will he be a dove with some hawkish accessories or a hawk with, dove clothing on? And I think that will be important because I lean toward dove with hawkish accessories because we can't forget about inflation. It's not gone and it really matters to the American people. But, there is a lot of investment going on there. And some people, I think, question what's going to happen. Like the markets are up a lot, right? And so you don't typically have rate cuts in a rising market. But we did a lot actually in the 90s a few times.
There has been, though, a lot of talk about letting this economy run hot and a lot of estimates on Wall Street for 7,000 and beyond. Your year-end target is 6,500. Right now we're trading at, 66 and change?
Yeah,
so we're there and gone. Are you going to raise your target?
Yeah, I'm thinking I might just look at the next 6 months or 12 months rather than looking out the next 3 because, I do think we're still, and the one reason I hadn't raised it yet is because, despite the Fed coming and an expected rate cut, that's all kind of priced in. And we are about to go into that period where stock buybacks end, you have quarter end rebalancing, which probably will trim some equity exposure. So I just was worried about that kind of next couple weeks period where you could see a little bit of a pullback. I would welcome that pullback though. I'm not bearish like longer term.
It is interesting though because a lot of institutional investors and hedge funds on aggregate at least, have kind of bearish exposure. Either they're little exposed to stocks or they are outright short stocks. The latest AAII survey shows bears outpacing bulls for the entirety of the past month. You obviously have a unique view into more retail-oriented investors at Robinhood. Where is positioning right now, and how much firepower is there to buy any dips that we might get?
Pretty bullish positioning, I'd say, on average. Definitely have had more buys and sells since the end of June, pretty consistently. That being said, we had our client conference last week at Hood Summit, and I definitely met some people who had taken a little bit off the table, and you do see that kind of trading within our customer base. Because you see that they do trim some winners over time, and you saw the trimming of Tesla and things like that. So I think there's firepower. It's just maybe not as much as it was from the retail sector.
Yeah, I mean, Tesla's still more than $1 trillion, right? So it's worth more than every single other car maker in the world added together.
His own stock buybacks helped a lot recently. But.
$1 billion, I mean...
It's a vote of confidence.
He's using credit on his shares to buy shares, right? I wonder about overexposure. Torsten Slok, again, put out a note today showing that investors are overexposed dramatically, he says, to AI and to the Mag 7. Are Robinhood customers also, you think, dramatically exposed?
They have a decent allocation. We use the Robinhood Investor Index as a way to do that, where we kind of take aggregate positioning over month by month. And the allocation is still kind of 40-45% of the overall index, but it's been falling. And actually, for the first time, Tesla is no longer the #1 holding. It's now Nvidia. And that's not necessarily, like, we do the analysis to see what is market movement versus not. So
maybe an unfortunate day for Nvidia to be your #1 holding, considering it's down 2.3%. Kevin Gordon over at Schwab put out a chart earlier this week showing that U.S. households hold a record amount of equity, to your point. So when you look at things like the United Airlines CEO telling Bloomberg yesterday that things are improving and there's lots of demand, when you look at retail sales coming in really strong, people still buying, how much of this is a wealth effect and masking over other parts of weakness in this economy?
I mean, I think from an earnings perspective, you've definitely still had the strongest earnings growth coming from the tech sector. And maybe like utilities and, places that like kind of benefiting from AI. And that is, I think, one thing that worries me with the markets, but the economy is not the market and the market's not the economy. I do also, like you see, when you look at like the highest short interest across the market and you look at the largest 1,000 stocks, the things that have done the worst and have the highest short interest are in the consumer sector too. And I also wonder, like, what does that mean? Is it consumers shifting the way they spend and not buying as many goods and still paying for services and experiences? Or is it that, to your point, like liquidity and a lot of private capital and the tech sector that's where the wealth is, which is why I actually think like investing has never been more important for the everyday person, because you're not necessarily going to level up your wealth through your job. Like you definitely have to make investments. And look, if it's through AI and the evolution of technology, I think that's where it is.
Stephanie, great having you in the office today. Thanks so much for coming to visit us. Robinhood Chief Investment Officer Stephanie Guild. Coming up, more on the Fed. As traders boost bets, the central bank will deliver at least 1/2 point cut by year end. We'll speak with Michael Darda, Roth Capital Partners Chief Economist and Macro Strategist. Next, this is Bloomberg Open Interest.
Well, we've fully priced in plus more 25 basis points of a rate cut today, but now traders are boosting bets on at least 1/2 point rate cut by the Fed by the end of this year. Joining us from Washington is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, if 25 is a lock today, what will the discussion look like in the Eccles building today?
Well, they're going to be talking about how much they're going to have to do and at what point do they want to go farther. and tell people that more cuts are coming. That's one of the key questions that we're facing today. It's complicated. There are many moving parts to what the Fed is doing today. The first, of course, is the expected cut and the justification for it. Is it because they are worried about inflation? Is it because they are worried about employment, the economy slowing down? And then we'll get the statement's forward guidance. Do they say, in considering the extent and timing of additional adjustments, as they have said in the past, or do they say additional cuts? Do they want to give that much guidance? The dot plot and the 2026 forward path, that's where you'll look to see if there's any kind of 50 basis point thought in there from members of the Fed. And then the dissents, of course, who and how many. And that could be really interesting. It's a little bit of a social puzzle here. You've got three members who have suggested that they wanted rate cuts already. Stephen Myron, new to the board, probably wants 50, may dissent because he's there for President Trump's views. And then Mickey Bowman and Chris Waller have suggested in the past that they need to cut rates. Now, Bowman has suggested maybe 50. Waller has not. But do they dissent? And then on the other side, you've got Jeff Schmidt and Alberto Musalem, who suggested there shouldn't be any cuts. Do we get a three-way split? And then dots go. The dots are going to be really interesting because we have two people adding dots this time. The new Philadelphia Fed president, Anna Paulson, and, of course, Stephen Myron, if he decides to submit a dot. He doesn't have to since he was only sworn in on Tuesday morning. But we're going to see whether or not there are going to be more dots suggesting more cuts in 2026. And if they add another dot to 2025 to get us to October and December cuts as well.
All right, Michael McKee out of Washington. Really appreciate the insight. Looking forward to your reporting today after you're let out of the lockup. And, of course, we will continue to type dots go on the terminal to see if Stephen Myron submits his. My guess is that he won't this time. For more on today's Fed rate decision, we're joined by Michael Darda, chief economist at macro strategist at Roth Capital Partners. And, Michael, you know, I always look at the Bloomberg financial conditions chart. You can look at a number of others. Citi has one as well that's popular. But these conditions do not seem restrictive at all. The dip that you see there on that chart is obviously Liberation Day, but we've come bouncing back from that. Does the Fed have to cut, or does the Fed maybe just want to cut?
A great question, and it's great to be on with you guys. Look, I mean, credit markets are extremely bullish at this point. And you could argue that, well, part of that is that we have multiple rate cuts priced in. But if you go back to 1 year ago, when the Fed went into that September meeting and cut by 50 basis points, financial conditions, credit market conditions are actually easier now than they were 1 year ago. And inflation on a 3-month annualized basis was very close to 2% a year ago. Now we're closer to 3%. So you have easier financial conditions and higher inflation today than you did a year ago. And so in my opinion, I actually think the case is less persuasive for the Fed. Certainly 50, I think, would be totally inappropriate, but even 25, you know, I think that they could end up delivering a message today that disappoints markets a bit if they don't flame those expectations, which are for, you know, rates to fall 140 basis points or so over the next 12 months. That seems a bit steep considering the financial backdrop here.
So, Mike, let's say we get that scenario, right, where you get Powell, you cut, he kind of pushes back against future expectations, the hawkish cut, or whatever you want to say. What happens if we get that? But you also get 3 dissents in the form of Myron, Waller, and Bowman. And maybe not even 3 dissents. What if you get even something more from Myron? What if he argues for 50, 75, 100 basis points worth of cuts? How would the market factor that into its outlook?
Yeah, great question. I mean, I think the Wall Street Journal described it as a strange meeting because of all the moving parts that you just articulated. Look, if Marin comes out and does something super extreme, I think he's just going to end up being dismissed by his colleagues and by the market. So, it'll really depend on what everyone else is doing. Obviously, Fed Chair Powell is quickly becoming a lame duck. He'll be done by the spring of next year. But I do think that there's quite a bit of division on the committee. I think they want to stay data dependent. Really what's changed here, at least from the last meeting, is the weakness in payroll growth, the private sector job growth, also weakened a year ago, but on a 3 or 4 month basis, it's weaker now than it was a year ago. So that's really what's fanned these expectations of multiple Fed rate cuts. And then obviously Powell did deliver a pivot of sorts at Jackson Hole. And so we'll see how we go from here. But I think it would be inappropriate for the Fed to really guide aggressively to further future rate cuts unless we see the unemployment rate really starting to shoot up in a way that it hasn't. I mean, a year ago, it was moving up materially year over year. It's largely been flat over the last 12 months, despite the weakness in job growth. And we're not really seeing that weakness that we're seeing in job growth show up in the activity indices, right? I mean, third quarter tracking estimates out of the Atlanta Fed are above 3% for real GDP growth. And if you look at real final sales to the private sector, up at 2.8, we'll get another revision today. It might come down a little bit with the weak housing data. But if inflation's tracking around 3, I mean, that puts nominal growth pretty close to 6. Is that a picture of tight monetary policy or a Federal Reserve that's way above neutral? I don't think so.
And to the inflation point, Michael, it's going the wrong way, right? If you look at the Fed's core PCE estimate, we've got it here. It's the white line. The blue bars there are the real GDP estimate. It's just going up above 3%. And although the Fed has promised to aim back down to 2, it doesn't look like they care too much about that right now. Is that just because savers, retirees have gotten this great gift from President Trump in the one big beautiful bill, so they can kind of ignore it?
Well, I think the Fed is trying to be forward-looking, and they are worried about the slowdown in the labor market. And their assumption is that, if that is real, then inflation ends up becoming more of a lagging indicator. So, I think we can give them the benefit of the doubt there. But boy, I mean, if you look at inflation expectations in the bond market, a forward-looking measure, they're about 50 basis points above year-ago levels at the 5-year horizon. And they were rolling over hard going into the September meeting a year ago when the Fed did 50 basis points. So I was much more favorable to the idea that the Fed should be aggressive out of the gate a year ago, whereas today, whether it's inflation expectations, financial conditions, the activity indicators, they really just don't support an aggressive move or even potentially multiple moves here.
All right. Great to get your insight. Really appreciate your intel, Michael. Michael Darda there of Roth Capital Partners talking to us ahead of this Fed decision at 2 o'clock today. Let's get to high interest now. We'll look at what's making headlines around the world. Americans' credit scores are slipping. The average FICO score fell to 715 in April. That's the biggest drop since 2009 in the financial crisis. It was attributed to higher delinquencies, especially on student loans, which do you really have to pay those anymore? Gen Z saw the sharpest hit with the average score falling 3 points. Bridgewater founder Ray Dalio is embracing family office life as he takes direct control of his fortune. The billionaire has stepped in as chief investment officer at Dalio Family Office following the exit of a top hire last year. Dalio is worth about $16 billion, says he's still passionate about the game and now leads a growing global team managing his fortune, investments, and philanthropy. In his words, "I'm the guy who the buck stops with, at least for now." A Spirit Airlines jet got too close for comfort with Air Force One that was ferrying President Trump to London yesterday. Air Force One and Spirit Flight 1300 were heading over Long Island when an air traffic controller noticed their altitudes and flight paths were converging. He alerted the Spirit pilots to change course and reportedly admonished the crew, saying, "Pay attention. Get off the iPad."
Why don't we have the sound for that? It's so good. He says, "I got to talk to you every time twice." Like, he gets mad on this call.
Maybe
it's
this
great.
specific pilot was his issue, or?
Well, he was like, "Look outside your window. You can literally see who you're close to. It is the president. Get out of the way." It's pretty epic. I highly recommend you go and listen to it. Anyway, still ahead on the show, U.S. mortgage rates fall to 2024 levels. We're going to discuss the outlook for real estate with Bess Freedman, CEO of Brown Harris Stevens. You're watching Bloomberg Open Interest.
right, let's take a look at the move screen here on the S&P. It's the most dynamic way to look at any index. You can see that we started out unchanged, and we came up a little here. We're down right now. It's only 0.1%, so not as dramatic as it looks in the chart. But 400 stocks are gaining, 100 stocks are falling. So that's interesting that we're down, even though breadth is to the upside. I took a look at the sectors, and this kind of explains why. So consumer discretionary, in terms of the sectors, let's get to the sectors here so I can make that point. Consumer discretionary is the biggest loser, and this is Amazon and Tesla really weighing on that sector. Consumer staples is the biggest winner, but there are no huge names in here. Walmart the biggest in terms of the top 10, but it's not even worth $1 trillion. That's why you see that little bit of discrepancy, Dani.
And Matt, just want to quickly mention that we have news on today's StubHub public offering. Shares are indicated to open between $24.50 and $25.50. That is above the IPO price of $23.50. Coming up, we talk real estate with Bess Freedman. That's next.
U.S. mortgage rates are on the way down. The contract rate on a 30-year is falling 10 basis points last week to 6.39%. The drop fueled a surge in refinancing that we haven't seen since 2022, all ahead of this afternoon's Fed rate decision. And of course, we're expecting to be a cut. So it could come down even more if the 10-year follows suit, which it really has been. For a look at the real estate market, we're joined here by our favorite realtor, Bess Freedman, CEO, Brown Harris Stevens, luxury real estate in New York, in South Florida. But I think it's a lot of the people watching are in those places too. So,
of course,
what's it feel like to you here? Like, how important is the mortgage rate in Manhattan for the high-end client that you serve?
So it's not as important because we see a lot of cash deals. I think something like 60%, give or take, depending. You know, these are luxury discretionary markets like Palm Beach, certain areas of Connecticut. So it's different. If we think about affordability as a whole in this country, the rates really do impact everyday people. Because, yes, rates have come down a little bit, but still buying a home is unaffordable for most Americans today, and that's what we need to solve for.
How do we solve for that?
Well, we solve for that in many ways. Obviously, rates coming down is a good thing. Zoning is important in local places so people can build. We need to have good incentives so people do want to build and have more homes. You know, prices have been really high, too. Those need to come down. Sellers have stayed in that lock-in mindset because they have low rates. And so a whole bunch of things need to happen together. And look, we saw the housing starts today were slow. And part of that is the labor market, right? And, you know, I think the president talked about if we got rid of illegal immigrants, you know, we moved them out, that we would have a stronger, you know, workforce. But we're seeing the opposite. And I think, you know, it's a tough time overall. We don't want to have a recession. So inflation's still sticky and, you know, jobs are slowing. And I think that's why, you know, the Chairman Powell is being very cautious and meticulous about how he's handling this.
I wonder about affordability and mortgage rates. Dani and I have been talking about this lately. If mortgage rates really do come down, I get that at the same price, that makes it more affordable. But if mortgage rates come down, don't prices go up?
They could. I mean, it all depends on which market it's relative and supply and demand. And look, it's not making a huge difference if they come down a little bit, you know, a quarter point, whatever it is. It's what the price is. It's what they're making. It's do they have a job? It's all those things, the cost for their kids to go to school. Everything has gone up, so it's relative. And so affordability is out of grasp for everyday home buyers. And we need to make that reality come back.
Well, there has been part of this issue that home builders just have been holding back, that they want to preserve margins. At what point does that change and they maybe go for market share and really start to amp up supply?
I think they have to feel some sense of certainty to make sure that we're not going to enter a recession, to know that the labor force will be strong, that they can have people, that the cost of goods is affordable. I mean, construction is expensive, right? So all of those things have to make sense or it's pencils down. And then if they don't have incentives to build, they're not going to go into the poorhouse to build housing. It doesn't make sense. So I think all of those things are really important as we think about housing overall, because it is important for people to be able to have shelter and, be able to raise their kids and have a home.
Obviously, in Manhattan, it's not all about purchases. A lot of people here rent, and those rent.
The prices are crazy.
Insane, right?
It's like Crazy Eddie. Insane.
Yeah.
It's insane. It's been.
But to the upside, rather than what Crazy Eddie was trying to do, before he went to jail.
Did he?
I got to ask you probably what you get asked most often now, other than mortgage rates. Dani. If Zoran Dani becomes the mayor and he puts in place rent caps, what does that mean for the New York City landscape?
I mean, we've seen that before and it's failed. And I think there are people that are concerned. There are alarmists that are worried that if he becomes the mayor, it's going to be detrimental to our housing market, to so many different things. But he only has so much power, and I think he'll work with the governor to make sure he does the right things. I don't think it's the end of the world. We've had bad mayors before. And I think he will work with everyone to try to keep New York strong, because that's his goal. He wants to have a good legacy. So, and if the people elect him, we all have to work with him. Whether I vote for him or not, we all have to work with him. So I think we will survive. That's my answer.
Bess, I just love the markets you exist in, because the thing that people always say is if they don't like Dani coming in or something they don't like about New York, they go to Florida.
That's right.
South Florida is where they go. How much of that has been lip service versus you actually seeing people making plans to maybe change and have a primary residence in South Florida?
I mean, that's been happening even before COVID.
True.
People have been moving to Florida. I think DeSantis held up like a sign with Dani, like being like, this is going to be great for us. And certainly there's going to be a percentage of people. I do know people who are selling now because they're concerned about it. I do know developers that decided not to build a project right now until they see what's going to happen. So there is a level of uncertainty, and people have been moving to Florida. But some of that is also for retirement, for a gentler sort of weather environment, for different reasons, jobs. So there will be some of that, but I don't think it'll be crazy like what we saw during COVID.
How often do you make a sale? Say I'm a hedge fund manager, I live here on Park Avenue, but I buy a place in West Palm Beach. I don't intend to occupy my West Palm Beach home as my primary residence, and I make that clear to the lender, but I still sign a document saying I'm going to have that as my primary residence, even though it's here. Does that happen all the time? Because it looks like it happens all the time.
I do not know if that, it could happen. I'm sure there's many ways where people manipulate the system to benefit themselves. So I haven't been privy to those discussions, but I'm sure those sorts of things occur because, rich people want to keep their money. So they're going to do whatever they can, to try to do that, hopefully legally.
I know exactly where you were going with that question. But isn't that part of the thing?
I didn't. I was like, yeah, okay.
But that's part of the thing. People barely can afford enough to buy one house. So part of the reason that this is such a thing is that these are people who have more than one house.
Yeah, these are people who have multiple houses. And we want people, for example, in New York City to have their second or third home in New York City because it's helpful for the economy. It keeps people here. It helps our restaurants. It helps growth. We want the economy to keep moving, right?
Well, and I would have, a rental property here if I didn't think the rent was going to get capped, right? Then I don't want to invest in that.
Well, look, there is part of the market that we have rent stabilization, but a lot of the market is free market, more than half. And look, we've been doing really well in the rental market. In fact, it's been unaffordable for a lot of people. And so I think rents have kind of hit their top. And hopefully that settles down and people can afford to be a part of the city.
Someone who rents in New York, I hope that is true.
You do rent in New York?
I do rent in New York,
It's
yes.
it really is. It's mind-blowing what you get for just a little room.
Rental in New York, own in London, which is a whole other issue.
It's
we
expensive.
won't get into that.
It's expensive.
Bess, this has been so fantastic. Please come back again soon.
Anytime. Great
Wonderful
to see you guys.
Wonderful to have you. That is Bess Freedman of Brown Harris Stevens. Now, the enthusiasm for Fed rate cuts has put some of the concerns over President Trump's trade war in the rearview mirror for many banks. Bank of America CEO Brian Moynihan shared his outlook on the Fed earlier on Bloomberg TV.
The tension the Fed has to deal with, and you've been picking at it all day is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. And so whether they do 25 basis points today or 50, people have to keep in mind, the growth rate in the economy was brought down, and now it's starting to go back up. So next year is predicted to be better than this year, and the year after is better than that. So you hear our teammates talk about the economy growing back out. And that then means we're on the other side of it. And so the Fed has to adjust to the inflation picture as it got more in control. They can come down. They came down 100 basis points already. They can keep coming down, but they got to be very mindful of the inflation side. And so I think when the people get in the room and they see the data, they have to think it through. The big news since that you referenced earlier was the labor market's gotten softer, so that gave them concern. So I think the market believes and our teammates believe they'll cut rates. But I think the key for people is deceleration of growth, and will the growth reaccelerate? You hear our teammates seeing that. We're seeing consumer spending strong and all those things, which would indicate we'd see the acceleration. Next year's better than this year. Unemployment is not expected to go up a lot, even though the employment picture may be softer. But the most important thing is the long-term interest rate scenario people projecting is a more normal rate environment that we saw before the financial crisis. Say 3% plus or minus on the Fed's fund rate, 4 to 4.5% or so on the 10-year rate, and a curve that's not inverted, that's normalized between that. The important thing is to get back to more of a normal environment, frankly, with maybe a little higher inflation, because the great debate about 2% is something you can get lots of experts talk about. A little higher inflation, a little faster growth, and then, frankly, that'll help with some of the debt carry and other things going on in the U.S. economy.
Bank of America CEO Brian Moynihan speaking on Bloomberg surveillance earlier. Check.
Can I just say quickly?
Yes, please, Matt.
That was amazing because Pharaoh and Lisa were at Bank America.
Yes.
Doing surveillance from Bank America.
Yes.
Moynihan was at Bloomberg in London.
You know who else is in London is President Trump.
Yeah, no, I just think that the juxtaposition is amazing that they were swinging offices.
But I think Moynihan might have had a pretty good reason to be there. But yes, point taken. Very meta, very ironic. Let's get you a check on markets because we do have that Fed rate decision. We are a little over an hour into your trading day, and stocks looking at the lows of the session so far, Nvidia weighing things down. That's why you see the NASDAQ down 1/3%. A shame because it has been quite the run for the NASDAQ, up for 9 straight days. But it is a 10-year yield, Matt. It is at 4%. We were not having this conversation just a few weeks ago. A few weeks ago was deficits are a concern, yields are going to go higher, and that's going to be bad for stocks. Instead, we are pricing in a dovish Fed, but is it sell the news at 2 p.m. Eastern?
Yeah, it's pretty shocking to see yields go that low. We saw them dip down on Liberation Day, but otherwise they haven't been below 4% since before the election last year. And I mean, for a lot of people, that's a fantastic development, and companies as well.
Let's get a look at in the White House too, I should say.
Exactly, and he's been pushing for this, and he's been successful at getting it down. Let's get a look at some single stocks moving at this hour. Lyft is partnering with Waymo to offer robo-taxi services in Nashville starting next year. As part of the partnership, Lyft will also construct a fleet management facility with charging capabilities. And you can see Lyft, wow, they're up 11, 12%.
Yeah, chunky lead there. Nvidia, though, that's falling to the downside. We pointed this out. China's internet regulator told the country's biggest tech companies to stop buying all of the company's AI chips, terminate existing orders. That comes from an FT report that suggests China maybe has their own AI homegrown chips to compete with Nvidia.
Eli Lilly is interesting, now up 1.33%. Patients on Eli Lilly's experimental diabetes pill lost more weight and had better blood sugar control than those on an older approved rival from Novo Nordisk in one head-to-head trial of the two medicines. Were there two?
Well, so it wasn't a head-to-head one, but there was an earlier study published that showed the weight loss in the pill of Eli Lilly's was worse than the Novo one and worse than their shots. So Lilly was originally falling this morning. But I don't know, I guess one study shows something different and shares move higher. Okay, coming up, Treasury Secretary Scott Bessent, just like Fed Governor Lisa Cook, once made contradictory mortgage pledges. We're going to have more on that Bloomberg story coming up next on Bloomberg Open Interest. Treasury Secretary Scott Bessent once agreed to occupy 2 different houses as his principal residence at the same time. That's according to documents seen by Bloomberg. It's the same kind of contradictory pledges that President Trump has been using to oust Fed Governor Lisa Cook. For more, Bloomberg's Zach Miter, who co-authored this story, joins us now. And Zach is a Pulitzer Prize winning journalist. So happy you're here with us, Zach. And this story is fantastic. And you go on to really lay out that he's not necessarily done anything wrong, but neither has Lisa Cook. I guess that's the point, isn't it?
Yeah, definitely in Bessent's case, there's no way of interpreting the facts other than that he didn't do anything wrong here. But rather, maybe there was a piece of paperwork that somebody forgot to file that would show that he didn't actually have to live in these two places at the same time, which is obviously impossible.
So, first of all, I want to point out Bill Pulte tweeted after your story and pointed out that Bessent said previously, if a Fed official committed mortgage fraud, they shouldn't be serving as one of the nation's leading financial regulators. And he is, as Treasury Secretary, honestly, one of the nation's leading financial regulators. What has Bessent and what has his team said to you?
Right. So Bessent and his team have been very clear from the beginning, and this is true. He did absolutely nothing wrong here. He didn't mislead his lender, which is the kind of underlying concern about these mortgage agreements, is that maybe the scenario that could be mortgage fraud is if I buy a house and get a mortgage on it and I live there, and then I go somewhere else and I say this will be my primary residence. I might get more advantageous terms, a lower down payment or a lower interest rate. And if I lie to the lender about my intentions to live there, that could be mortgage fraud. And so when President Trump is using those contradictory pledges to try to oust Lisa Cook, he's saying those pledges show maybe you committed mortgage fraud.
But she had also, at least according to Reuters, pointed out to one of her lenders that it was a vacation home.
Right. She has a document showing, at least in one of the cases, the lender gave her a loan estimate calling it a vacation home. So maybe there was just a paperwork error that ended up with referring to that as a principal residence. That's definitely what happened in Bessent's case, because it was the same lender, right? So the same lender couldn't possibly have thought that he was going to live in two different places at the same time.
So the fact that we have these documents, the fact that this seems to be somewhat commonplace, how does that factor in to potential court decision around Lisa Cook?
Well, it's not clear whether that's what's going to hinge the court case on, because Cook has argued that even if I had done something wrong prior to being appointed to the Fed board, that's not cause to fire me, and so that's an issue that the courts will have to determine is true or not. So it's possible that even if she had done something wrong, she's arguing she doesn't even have to be, she couldn't be ousted anyway.
There are some striking similarities here, but you also point out that there are some real differences. The one that stood out most to me is that Lisa Cook's two properties cost a combined $743,000. And these two properties for Bessent were what, $21 million?
Bessent was in a whole different stratosphere.
Yeah.
He's a wealthy hedge fund manager. And it was part of a $21 million financing that involved a bunch of different assets. But part of the
So more than the house in Bedford and Provincetown.
That's right. But part of the security that Bank of America got in return was mortgages against those two homes. And they filed the standard mortgage agreement that everybody signs when they buy a house that says you have to live there. Now, typically, there's another document filed called a second home rider that would say, forget about that principal occupancy thing. You don't have to do that. We didn't see that in either of the cases here.
All right, Zach, it's a great story. I really love the way it's written, laid out perfectly. I recommend everybody check it out on Bloomberg.com or on your Bloomberg terminal. That was Zach Miter, one of the co-authors of today's story on Scott Bessent. Coming up, ticket platform StubHub is the latest company to go public. The IPO today, it's about to start trading. That's next. This is Bloomberg Open Interest. We are waiting on StubHub to start trading. It's indicated to open between $25 and $26 a share. It priced at $23.50 and raised $800 million for the company. Joining us now is Kevin Neer, Bloomberg Intelligence equity research analyst. This kind of surprised me because IPOs have been so hot lately.
Yep.
And I think the book was 22 to 25,
Yep.
and they went right in the middle. Why isn't this like top of the range, oversubscribed? Are we losing that enthusiasm?
Yeah, it's a great question, Matt. I think that, there's really, valuation was the big question for us coming into this. Where were the shares going to price? We've been looking at a lot of comps. If you look at, where Live Nation is trading, where Vivid Seats, their closest competitor, is trading, these are priced at a significant premium to those ticket platform peers. So really, the company is likening itself to a growth story. It's saying, look at us as a technology stock, and really we're going to be investing in the near term to be able to achieve that 20% plus top line growth target that they've been talking about in the roadshow.
If you look about the big IPOs we've had this year, and I mean, they have come back, but it has been crypto. It's been tech like Klarna. You're saying that StubHub is trying to position itself, look, we are a tech player. How important is it in this market, even if IPOs have come back, that you're either a crypto or a tech company?
Yeah, it's tough to say. Like I said, there's definitely mixed catalysts going on. I mean, the economy, for secondary tickets specifically, StubHub, that's their bread and butter. And it really depends on demand. Are people going to be willing to pay up higher and higher for these in-demand events? But really the question is, what's going to happen on the regulatory stand front? I think that's really where a lot of, some of the mixed sentiment comes in. But ultimately, like you say, there's clearly a lot of interest in IPOs.
What about interest in shows? I'm looking at the StubHub page and I see Lady Gaga right at the top, which,
I think those tickets are like $1,000 a piece for the worst seats.
So people are still paying a ton of money to go to these.
People are still paying, especially at the top end. For the most in-demand events, for the stadium shows, for the finals, the playoff games, the sports side. People are really willing to pay for that, and you look at the investments that the venues are making. That's just driving ticket prices up higher and higher, which obviously means higher service fees for StubHub as well. So we'll see if they're really going to be able to make inroads on the direct issuance game. That's really where they see the next leg of growth.
You mentioned some of the regulation. I think Washington D.C. has a lawsuit with StubHub. There's also Pennsylvania and New York that they're facing inquiries over. How are those shaping to look up, and how precarious is it for StubHub as they try to fight some of the regulators on it?
Yeah, it's a very complicated landscape going on right now, and we're actually waiting for proposals from the FTC that should be due out in the next couple of weeks. This was back from an executive order that was issued in March, where the administration was asking for suggestions to combat unfair practices that they see in live ticketing. So there's been a lot of articles, a lot of headlines that have been going across about, are they going to be going after the resale market more aggressively? Are they going to be going after Ticketmaster more aggressively, who's still fighting their antitrust lawsuit as well? So that really is the big question. Ultimately, if you listen to the CEO, Eric Baker, he sees that, there are problems in live ticketing. Transparency will help. And ultimately, exclusivity is a problem as well. So the more tickets that are on more platforms, ultimately that's better for the consumer, and theoretically that'll be better for StubHub.
But they want more exclusivity.
They want less exclusivity.
Oh, I thought they were looking for more direct sales. I figured that was an exclusive.
Right, direct sales, but they don't have to be exclusive to StubHub. Ultimately, there's no brand loyalty for a consumer. They just want the ticket. They want the best price possible to be able to go to the show.
Fair enough, Kevin. Thank you very much. Setting up that IPO. Kevin Neer, Bloomberg Intelligence. Let's get a check on markets. You got a big Fed decision today, and probably not a lot of action in this equity market. Yeah, we're pretty much flat. NASDAQ, though, falls. Yields kind of ticking higher, but for the most part, not moving that until we get the Fed decision. 2 p.m. Eastern, Bloomberg Surveillance will have a special on that.
Yeah, it's interesting that the NASDAQ is falling so much more than the S&P. I know
Nvidia.
that Nvidia is worth more. It's worth 12% of the NASDAQ and like 8% of the S&P. Coming up tomorrow, Michael Kantrowitz of Piper Sandler joins us, and Meredith Whitney as well. This is Bloomberg.